What you find in studying history is that depressions are mostly debt and liquidity crises. That I'm saying, let's say, if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things, no. I think the most important thing is to start with diversifying well.
This is Ray Dalio, one of the most successful hedge fund managers of all time. He manages a very large hedge fund. Well, let's listen to him first and see what he says, and then I'll give my comments to give context and analysis in a moment.
Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility, and because the markets are relatively efficient in making those comparisons.
There's a few assumptions here, but we'll talk about it a bit later.
It's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums are a bit lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable, because the individual items that make up will all have low returns, but the combination of them will make it more stable. The concentration in any one asset class, in any one country, in any one anything, history has shown is dangerous, and it is dangerous now. So when I look at it, for example, what we're seeing is reflation.
Okay, so I'll stop sharing and just talk a little bit about this, because I think it's interesting. Now, what I'm going to show with some of the visuals is that Ray Dalio manages one of the largest hedge funds in the world. Hedge funds in general manage large money, but he manages the largest of money. And I think the minimum you need to invest with Ray is about $7 billion with a B. So the context is he's making and creating and crafting content and making videos in general, like the video you just watched, from his perspective of managing billions of dollars, not $100, not thousands, not 100,000, not a million, billions of dollars. So there's a different type of investor when, you know, that might be pension funds or enormous family offices, that kind of thing, sovereign wealth funds maybe. And these people, and the people behind the contacts at these companies and organizations, think very differently to me and you. They might, you know, they may have enjoyed returns in the past, but now they are looking for stability. And when you have that much capital, it's very, 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 very difficult to deploy it in small companies or in individual stocks even, because it's just so much, you know, so there's so much capital there. It's the kind of Warren Buffett problem as well. If you have 40 billion to invest every year, or whatever it might be, 20 billion every year, you know, there's no point in looking at very, very small companies like a cake box or something like that, because, you know, cake box is only valued at 50 million. You know, he could probably buy it every day of the year almost. So, you know, and that's the same with Ray Dalio. You know, the reason why he is talking about stability is because he wants to provide stability for his clients, for, you know, these large clients. However, there's very important lessons. I think I do agree that diversification in the next period of time, whether it's 1 to 2 years or maybe up to 10 years, I don't know how long it's going to last, but I do think there's uncertainty in asset markets. I do think there could be a lot of volatility as people cycle out of stocks, as VC and angel capital might decrease as discretionary income and spending decreases, there'll be less earnings potentially in the equities market as well for the companies that exist there. Properties, there's valuation risk there and regulation risk there. Cryptos, cycles around other asset classes anyway. So I do see risk. Nevertheless, I'm not about doom mongering the whole time. I want to stay positive, and I do think there is going to be some value. However, I do think there is some valuation risks. So what are the ways that you can reduce valuation risks and your potential risk in general? I would say, yes, diversify across countries and asset types. Also, cost averaging is a good way of doing it. So instead, and I have made this mistake in the past myself, instead of bulk investing at one period in time, thinking that's the best time, only to find out a year or two later, the asset that you purchase is down 20%, 30%, 40%, whatever it might be. If you do it over time, then you're likely to get a weighted average price that you've paid, which means that the ups and downs are kind of lessened. That's one way to avoid that. Hope you've enjoyed this video. Remember to like and subscribe. Knowledge is power, especially the right kind of knowledge, and progress is everything. I'll see you guys in the next upcoming video. Take care.